So what I have done, I have shown here over the previous slides that uh, what had happened to the market and what had happened to the Indian markets. Indian markets is completely decoupled with the global as of now, and except the Fed rate issue for that matter. And then how the different sectors had been impacted, how the different indices were impacted, and within sectors we have identified 2 or 3 how the trend has been, what had been the range of impact, where one has been like auto segment being positive and the rest being negative. Among them also you can see the chemicals being in the ditch, and infra and metals being in the ditch. But then all this thing, if you are a very avid stock investor and you have a very big stock portfolio, you need to monitor it. So in need to monitor it, there are certain parameters that you need to look forward to it. So here comes the portfolio parameters that are there that you should look when you are managing portfolio on your own. We, for our clients, do it at our end, but say for example, for any portfolio, you have to see that, okay, I am having the number of stocks. So which are having the risk reward. Risk reward simply means, he say for example, if I have invested into a stock, obviously I have invested into a stock for a profit. So therefore I have put a target price and there's a current price at which I had bought, and there has been the variations. So the risk reward tell me and the amount of risk I am taking for the amount of reward. So for example, for every 1 rupee of the risk I take, I will make 3 rupees. This is the favorable risk reward ratio. So when we look at this, and because the markets have been impacted quite gravely and many of the stocks had a straight fall, there would be changes every day as you would see it. So here, if we say among the current portfolio of the stock, because this is the template for it, it shows that the 11 are having the best risk reward ratios, 6 are still having favorable, and 2 are having average. So therefore, if we say that 6 plus 2 is 8 plus 11 is 19. So 19 stocks are favorable and 9 are which will require action. Now there point to it. Either you can look each and every stock every time, or you will have a template that will show you, okay, I have a 50 stocks or I have a 10 stocks, and these are the 9 stocks where I need to take action on. So this tells you where you need to focus. Then for example, we say that okay, for every trade I am willing to take 1% of the risk. If I am willing to take 1% of the risk, and we are taking, say for example, a 50 lakh of the portfolio, I'm looking at around 50,782 on a per trade risk. Okay, any of my stock, if I am willing to exit it per stock, I am willing to make a loss of around 50,000 if I need to exit or make a maximum loss of daily risk limit maximum at the portfolio level. This is at the portfolio level. So unlike current situations when the whole market is falling down, you cannot just keep on buying, selling, buying, selling, buying, selling. So you have to find a midway path where you say, okay, I am making a partial exit, I'm protecting the profits that are with me, and for the rest I'm trying to view the markets, hold my positions, and then see where I could average them out as the time comes. So therefore, if we see here, there we are looking at the daily risk. Say, suppose we can say that if today I will say the market goes down by around 5%, then should I exit? If it would have been a normal black swan event, then we would have come out of it. But we know that this is the election and Fed rate and couple of other issues coupled. It is not a black swan event. So therefore, we will keep on to it because there has a broad base. However, normally if you are very conservative, then we will look at, okay, hai, there have been a 1,50,000 of the loss, I will rather exit. But then the main risk with this is, if tomorrow the market goes up by 2% or 3%, you have missed out that spread. You cannot make it up. So then your story will start after over and above that 2% of the jump that happens. So that inherent return that would otherwise would have been there, you would have already missed the bus. So then obviously we can see that what is the maximum drawdown I am looking at, what are the total number of stocks. So I am having a 31 number of stocks. Out of 31, there are 11 which are good, 6 are favorable, 2 are average, and the 9 need section. My portfolio beta is this. This tells about the risk taking measure. This simply means that if Nifty falls by minus 5%, this portfolio will fall by to 69% of 5%. So that means if the Nifty falls by 10%, the portfolio will fall by 6.9%. So that means we are less risky than the portfolio. So we are, you can say, 69% risky. with respect to Nifty. So this is how it is. Now, obviously, we also have to see whether our maximum drawdown is within limits or not. Yes, it is within limit. Is our minus 3% daily risk limit in control? Yes, it is in control. This is the threshold value. This is the threshold. So in the threshold value, we are still in control. Now, we have total number of 31 stocks. Are we diversified? Yes, we are well diversified. We don't need to diversify more than that. This is the worst case scenario of the diversification. Being in the, you're getting like phenomenal large number. Optimal should be 12 or 15, but 31 on an average, the client wants around 20 to 25 stocks. So based on the client preference, it could be. So what portfolio beta? So portfolio sensitivity is less than the market benchmark. So therefore it is green. We are also good at this. Then we're looking at the stop loss. This is okay. Concentration list risk. Concentration list means sector exposure. Sector exposure, or no, not sector. I would say that this concentration risk is with regard to script per stock exposure. So that means, say for example, I have got 1 lakh rupees and I have taken say 10 different stocks. Now one stock is having 20,000, one has having 10,000, one is having 5,000. So the concentration risk is 5%. So if it is a 1 lakh, or you can say 10 lakh of the portfolio, then more, not 5% or more allocation should not be. Not one stock should have more than 5% of the allocation. So therefore, again, then you also have what are my stop loss. So how many are the number of stocks? How many are the number of stocks which have got the stop loss at the entry? We entered into the stock and then the markets were negative. So therefore, there have been this stop loss has been triggered in 7 stocks. Then we are looking at 3% beach. Now there would be a stock, say for example, we have got into a stock at 100 rupees and it has gone up to 120 rupees. From there it has fallen to 116 rupees. So at 116 rupees, the 3% stop loss has been hit. So that is 1%. So that means it is a trailing stop loss. I'm talking about the trailing stop loss. So whatever the money we are having, are there any client specific remarks that we need to be careful about? Say for example, the client doesn't want to get into Reliance or any other stock per se, so we can just make a remark, the client is not into this. Or if a client has some stock blacklisted because he's already working in that company, doesn't want to be investing into that company because it would amount to insider trading, so therefore we are having this type of remarks that we do put into. Then we have the number of buy recommendations. So that means we are now looking at number of the recommendations buy, and there's a vacancy of minus 19 because we are normally looking at 12 stocks approximately. It is already well diversified, so that is minus 19. So therefore we will not be making any changes into the portfolio because it is already well diversified. Had it not been the case, then based on the number of the buy recommendations, we have taken the top 2, top 3, top 10 stocks and then made a change into it. What are the cash balance we are looking at? We are currently sitting on. So therefore, if tomorrow an opportunity comes in, we will just pull in our money into it. And what has been the money that we have kept into the liquid B? So this is how you can see the whole portfolio parameters are parameterized and tracked so that the better portfolio management is actually done at the ground level. Now, while you want to get this information on your dashboard, there has to be some data that needs to be fit. So therefore, you need to know certain aspects from your portfolio. And what does that mean? That means your stock holdings. These are your stocks. So if I say these are your stocks, we are looking at APL Apollo, we're looking at Ashok Buildcon, so on and so forth. So what we are looking at? We are looking at what is the weightage. Say if I have invested 10 lakhs into a portfolio, how much? So this stock is having 4% of allocation. This is having 2.9% of the allocation. It is having 1.95% of the allocation. So here, if you see that the concentration risk will be actually 0. Stock concentration risk is no, because this is currently at less than 5%. So no stock is having more than 5% of the allocation. So then comes the portfolio beta. We have calculated that 6.9% is the portfolio beta, that is calculated based on per script volatility measure. Then we know that, okay, for every stock we have taken certain target price and we have to see what is the target risk reward ratio, what is the current values that have come with it, then whether that risk reward ratio is favorable, average, best, or we need to watch out. So that based on the financial model, based on the metrics that we have put into the system will tell us which need to be acted upon, which are best, which are average, which have to be washed out and to be acted. So therefore, rather than looking and digging into each and every stock for that matter, we can directly look into the stock that needs to be actioned upon. So then obviously we are having the stock. So whether we need to exit out of it or not, that depends on the stop loss. So these are the different parameters on which we say that, okay, we need to exit or not. So now this is a proprietary financial model we have developed. So based on this, we'll just see whether we want to go for a, you can say, trailing one, or we want to go at the highest price entry. So that is how we can look at it. And if there are any auto actions, it will sell. So based on the parameters that are happening, we know that this has been triggered, this has been triggered, this is the watch out, and target has not been hit. So based on the parameters, it has told that, okay, we need to come out of it. So here in this case, it is saying that this is to be there. While this is the batch, we know that the stock has gone down, we need to exit out of. So based on our logic, it has told that to come out of the stock, sell. Now again, for all these things, there are the exceptional action. That means an oversight by the fund manager or a broker or an agent or all those analysts needs to be there, who would look into it and then decide whether we want to hold it, or we want to sell it, or we want to monitor it. So you want to monitor it, you want to hold it, or you want to sell it. So therefore, so it does not mean it is not about robotics. You can just put in the numbers and the robot will tell you buy, sell, buy, sell, buy, sell. You will keep on churning the portfolio without any official result coming out of it. So having said that, putting the at the end of this analytics is the prudent, or you can say the knowledge acumen and the information based upon the market inputs that a fund manager has to decide whether he wants to hold, monitor, or sell the stock. So this is how, now when you do this, that is when your portfolio parameters are filled in. So if this is right, then your this is right. So at the portfolio management level, we look into these parameters for that.